started with the irrelevance proposition, which is suggested by the Modigliani and Miller. So this is so-called M&M theory in capital structure, and they said, according to their paper, they say the firm's value is not related to the firm's capital structure. So the capital structure itself is not important, and we don't have to care about it. So that was their claim, because the firm value will not change due to the capital structure. So whether you want to have a 100% equity finance company, or whether you want to have a mixture between debt and capital, equity capital, it does not matter. And then in reality, some things are different from the irrelevance proposition, because contrary to the assumptions behind the irrelevance proposition, actually in reality we have tax, and the existence of the tax affects firms' behavior and subsequent their performance. So more importantly, we have interest tax shield. The interest tax shield means that because you pay interest expenses before you calculate your corporate tax, so the corporate tax will be reduced when you have more interest expenses. And when do you have more interest expenses? When you have more debt. Therefore, by increasing debt, in other words, by increasing your leverage, your tax will be reduced. So there is a tax reduction, and in that sense, this is called as a tax shield. Therefore, if you think the tax payment to the government as a expenses or the waste of your money, then you will be better off whenever you save taxes as much as you can. Therefore, your firm value will become higher when you have more debt. So that's their proposition, and that's the strongest advantage when you have a debt or leverage in your capital structure. So as the graph shows, your actual firm value is here. However, your realized firm value will become higher and higher when you have more debt, because you can save some taxes, and that will benefit your shareholders and your investors. And therefore, the conclusion from this argument is that actually you have to issue more debt as much as possible and whenever you can do. So you must target 99% debt as the target capital structure. So that will be the conclusion from the M&M theory. But however, in reality, not many companies do want to have a 99% debt in their capital structure. On the other hand, sometimes they are very redundant to increase their leverage. They try to maintain a more stable capital structure. And what will be the reason? The reason is that they have bankruptcy. So when a bankruptcy occurs, the ownership of the corporation will transfer from the shareholders to the creditors. So the owner, in usual times, the owners of the companies are shareholders. However, if a bankruptcy occurs, then shareholders will lose their power and the creditors will claim, and this company is now ours, and they are going to control the company as whatever they want, and they are going to fire the existing managers, and then they are going to maybe they want to have new managers who will do do the business as the creditor wants. So there are two kinds of choices the creditor can do. The first is the liquidation. When the creditors choose to do so, the company will stop operating, and soon the company will be terminated, and then the assets will be sold and the money will go to the creditors. So although the remaining assets are not sufficient to cover the losses of the creditors for 100%, however, still creditors can have, for example, they can recover 70% or 80% of the money they invested in the company. So that's why they choose to liquidate. On the other hand, creditors may give the company the second chance, and this is called as a reorganization. So in this process, in the reorganization process, creditors and the company will negotiate about the existing contracts. For example, suppose that the creditors originally the company originally borrowed $100 million from the creditors. Unfortunately, the company was not able to pay the money back, and the company has only say $60 million. And then this is the situation where the company go bankrupt, and creditors can choose between liquidation and the reorganization. And if the creditor choose to liquidate the company, then the company will be terminated and the money will be distributed among the creditors. On the other hand, if the creditors choose to reorganize the company, then the company can survive. However, maybe because the existing debt is too high, both of the parties know that the company cannot pay the full amount of the borrowed fund, $100 million. Therefore, maybe they are going to talk about this, and maybe creditors will allow that if company pays only $80 million later, then they will be okay. So they will not claim another legal things again. So that's the kind of the reorganization, and through this reorganization, so the company was able to survive, and then later, if the company continues to operate and if they are successful, then the creditors, both the creditors and the shareholders, will gain more, because now the company can continue. So these are the two processes that the creditors can choose in the situation of the bankruptcy. But anyway, let me go back to our issue here. So whatever happens, the bankruptcy is very dangerous situation, and as the existing shareholders, this is a very strong threat, because they are going to lose what they have had in the company. So shareholders try to avoid the bankruptcy situation, and at the same time, because the shareholders are the owners and the managers have some kind of duty to maximize the shareholders' wealth, the managers will also try to avoid the bankruptcy situations. So the bankruptcy and the related costs are very huge, and they are referred as the financial distress cost. And there are direct costs such as legal fees and consulting fees, but also the indirect costs such as if there are certain beliefs that a company can go bankruptcy, then there will be a lot of disadvantage. For example, if the investors feel that this company is now in trouble, and maybe 1 or 2 years later, there is a possibility that the company can go bankruptcy, then those investors may not provide financing. So it means the companies cannot raise external financing needed, even though that the company knows that if they raise this money, then they can use it to survive. So that's the indirect cost, one of the indirect costs. And the second is that, for example, let's say you want to purchase a car, automobile, from an existing company, and there is a rumor that a particular car manufacturer is in trouble, and maybe there is a possibility, maybe 50% possibility that the company can go bankrupt in 2 years later. Then you may not want to purchase your car from the company, because maybe if you get the car, then you will use it for example 10 years. But if the company goes bankrupt in 2 years later, then it means you will not be able to get some kind of services from the car company anymore. Therefore, you don't want to purchase the products or the services if you believe that the company has a serious financial distress events. And third, not only the customers but also the suppliers are aware about these situations, so they will argue that from now on they want only 100% cash instead of credit sales. For example, they are not going to have you the accounts payable. So it means now, despite the fact that you are insured of the cash, now you need more cash because you have to pay in cash 100% for every transactions. So you will get more and more trouble. And if the company is in trouble, then your employees will also leave the company. So for example, particularly this problem is more severe if your employees know that they could find their jobs easily. So especially those with high skills and reputations will leave the company first. So your human capital will be also affected adversely. So all kinds of those situations are the indirect cost related to the financial distress or the bankruptcy. So therefore, now we know that we have to avoid the bankruptcy situation, and it gives you some kind of two forces making an equilibrium. So on one hand, there is an advantage, which is the tax shield. So by having that more and more, you can gain the advantage of saving the tax payments to the government. But on the other hand, there is a disadvantage that if you rely more and more in debt, then you will likely to pay more. So you will be in more financial trouble. So there is a financial distress. So there are both advantage and the disadvantage. So it explains why companies do not want to have 100% equity or 100% debt. So they are in some kind of two conflicting issues. So they want to make a balance between these two. So that's why we often see, in reality, we often see companies with 50% of debt ratio or 60% of the debt ratio, but we do not observe firms with 99% of the debt ratio. So this is the core of the static theory of capital structure. So the static theory of the capital structure proposes that there is a tax benefit and there is a financial distress cost. So therefore, the firm would choose between somewhere between these two extraordinary situations. So there is a optimal level of the capital structure. So this graph represents the results of the static theory. So here the yellow line was the value of the firm, which if you don't have that at all, and the firm value increases following the blue line because you can enjoy the tax shield from the debt. So therefore, theoretically, following Modigliani and Miller's argument, your firm value will increase whenever you have more debt. However, in reality, at some point, your firm value will start to decrease as you increase the debt because there is more and more financial distress cost related to the bankruptcy. So therefore, you will find certain point where the firm value is maximized. So this is the optimal level of the debt for your company. And therefore, what companies do is to try to find certain point based on their characteristics and their circumstances, and they do not want to have 99% debt, or they do not want to have 100% equity. They may have some kind of 50 or 60% of the debt ratio. So now we can draw the two pies we discussed in the previous lecture again. So in the original version of the two pies, we just claimed, let me go back there. So this was coming from the irrelevance proposition, and in the original version of the two pies, we do not care about anything else, but we were just thinking about the distribution of the pie between shareholders and the creditors. And in that special case, we do not have to care it at all, because this is just a matter of the distribution. This is not related to the size of the pie. However, now the situation have changed. Now the pie is again the same. However, now we have four parties. First, before our investors, before the stockholders or the bondholders take their pies, their slices, first the government will come and take the taxes out of the company. So when you have more debt, the tax claims become smaller. So this is the situation where the debt is smaller, and this is the situation where the debt is larger. And here the tax claim is large, however it will be reduced thanks to the interest tax shield. And at the same time, we also have to care about the bankruptcy situations. So we have a bankruptcy claim. Contrary to the tax claim, the bankruptcy claim is smaller when you have a lower debt, but on the other hand, the bankruptcy claim will become larger when you have more debt in your company. So the rest of these pie slices will belong to your investors, stockholders, and creditors. Therefore, now, although the total size of the company may be the same, however, now what they get is different depending on how much debt you have for your company. So that is the revised version of the two pies. Right. So far we talked about the classical theory of the capital structure, and the main arguments that you need to remember is there are two things you remember. First, we have a tax shield effect, and second, we have a financial distress cost, and it can explain why companies try to have different capital structures in reality. And in the next week, on Tuesday, we are going to talk about a case study based on this static theory of the capital structure. And the rest of today, we will going to discuss the pecking order theory, which is somewhat different from the classical theory that we have been discussing. So the pecking order theory suggests that there is a pecking order. So the pecking order means there is a order you choose. So there is your preference. So you have a higher preference towards something, and you have a you don't want to do something other else, and therefore you follow these specific orders when you need to have external financing. And the order is given as: first, whenever possible, you should avoid external financing, and you have to deal with the business only with your internal financing. Second, when you need to raise external financing, and if it is not possible to then possible to avoid, then you should choose that instead of equity. And as a last resort, you can do equity financing. So according to the pecking order theory, you can briefly remember that that is better than equity. And I'm going to explain why. And another difference between the pecking order theory and the classical theory of the capital structure is that in the classical capital structures, including the static theory, they assume that there is an optimal point, and the company wants to have this point as the target. So they have a trend, and they have a objective, target, goal. But on the other hand, in the pecking order theory, they say there is no such thing. then the company will choose depending on everyday situations. So today, if debt financing is better, then they will do better debt financing. If 1 month later, then if the debt financing is not possible, then they will go equity financing at the time. So there is no long-term objective in the capital structure. So so understanding why the pecking order theory makes sense, it can be somewhat difficult if you are not familiar with this kind of argument. So let me explain why this can happen through an example. So let me assume that we have two imaginary firms. There is a good incorporated and bad incorporated. As the name implies, good incorporated is a better company compared to the bad incorporated. However, the problem is that investors actually do not know which one is good and which one is bad. And the only thing they know is that their average performance, they only know about the average performance of the companies. And let's just say these two companies consider equity financing of $100 million. So they want to have the seasoned equity offering, for example, and these are the results expected. So the good incorporated has, at this moment, they have assets of $150 million, and they are going to raise $100 million from outside, and they are going to use it as an investment, and as a result of their investment with $100 million, they expect to earn $20 million more. So after the investment, the firm's value will increase from 150 to 270. And on the other hand, the bad company, bad incorporated, has only assets of 50. So the firm value is already smaller than the good incorporated. And if they invest the same amount of money by raising capital from outside investors, the performance is bad, so they only expect to earn 10. Therefore, as a result of their investment, after this investment, the value of the bad incorporated will be 50 plus 100 plus 10, which is 160. So the good incorporated, the managers of the good incorporated know this fact, and the manager of the bad incorporated know this too. However, the outside investors do not know these details, and what they only know is that in this industry, the average firm value is 100, and if they invest $100 million additionally, and they are going to earn $15 million on average. So 100 million here is the average between 150 and 50, and the 15 here is the average between 20 and 10. So as a result, on average, the firm value after the investment will become 100 plus 100 plus 15, so it will become 215. So let's say the company raises equity financing, and the investors will get the shares from the company because this is the equity financing. So the company will issue new shares, common stock shares, and therefore the outside investors is buying those new shares. So they will become new shareholders. And from the investor's point of view, you can claim something like this. Okay, we have the average firm value of $100 million before the investment. So, and now here we comes and we gave them $100 million. And thanks to us, you were able to increase your firm value to 215. So therefore, we have to get at least $100 million worth of shares from your firm. So we want to have the control right, the ownership of the company as much as 46.5%, which is 100 million over 250 million. So it makes sense because if there were no such investment of $100 million, then the company value should have not increased to $250 million. So now the investors, new investors are participating as the shareholders, and therefore they have shares, and the total proportion of the shares given to these investors will be 46.5%. Therefore, from the point of view of the existing shareholders, the shareholders before this investment, their ownership will decrease. Before this investment, they have, as a group, they had 100% ownership. However, now they gave the shares to the new investors, 46.5%. So what they remain is only 53.5%. And based on this ratio, now the investors will get the dividends and everything from the company. And now let's imagine the case of the Good Incorporated. So if Good Incorporated raises equity financing and invest, actually the firm value will become 270. So therefore, as the result of their investment, the existing shareholders, the shareholders before the investment, will get 53% portion of the value, which is $140 million. However, it is somewhat ironic because if Good Incorporated at the beginning gave up the equity financing and they never made such investment, then they had 150. And furthermore, the existing shareholders can fully enjoy 150 by themselves. They don't have to distribute this with the new investors. So they can have 150 if they choose not to raise equity financing. So therefore, in the case of the Good Incorporated, for the sake of existing shareholders, Good Incorporated should not raise equity financing. In the case of Bad Incorporated, this is different because if the Bad Incorporated raises equity financing and invest, then they can have 160. And with the same logic, the existing shareholders, the shareholders before the investment, will get $86 million in total. However, this is better than better than the situations before the investment, because if there were no such equity financing and the investment, then their firm value was only 50. So although they don't have to distribute their money to the outside investors, they only have $50 million, which is lower than the investment, which is lower than the outcomes of the investment. Therefore, in the case of the Bad Incorporated, for the existing shareholders, the company should raise financing and they should invest. So now we have two different companies choosing different strategy. For Good Incorporated, this company will not choose invest, and they will only choose not investing and not raising equity financing. On the other hand, for the Bad Incorporated, they will always choose to raise external financing and invest instead of not investing and giving up their investment. So even though the investors at the beginning were not able to distinguish these two different companies, now the investors can observe what they do and can imagine which one is one. So if you find some companies investing through equity financing, then this should be Bad Incorporated. And if you find some companies giving up investment and just maintaining its current status, then this should be the Good Incorporated. So in that sense, equity financing is a signal that your company is actually worse than the others. So that's why we often see that in the stock market, the stock price becomes lower and lower when a company do the seasoned equity offering, because the equity financing is a bad signal. And following this, the pecking order theory, from this result, the pecking order theory suggests that you should avoid equity financing whenever possible. So if some companies are raising equity, then it means they don't have any other choices and something is wrong with the company and they need the money urgently. So that's why we do not want to have such situations. And generally, if you check the statistics from the reality, we can see that actually firms with less debt are usually profitable. This is because they don't have to raise external financing, because they have much cash generated through their operations inside the company. So in other words, they have sufficient inside funds, so they don't have to go to the external capital market. And that's why they don't rely on the debt, nor they raise equity financing. They do no financing from the outside. So now we have talked about two different strands of the capital structure theory. And now let me wrap up. First, we talked about the static theory of the capital structure, and it implies that there is an optimal capital structure. And then this theory is more suitable to explain about the long run strategies. So they assume that there is a target, what they want to be in the future, and eventually they will go there. For example, it can take 5 years, 10 years, but eventually they are pursuing to go to the target. On the other hand, the pecking order theory suggests no optimal structure, and what companies do is to choose their behavior depending on their circumstances. So there is no strategy. However, instead, it is more suitable to explain their short-run behavior. So it can be called as a tactics rather than the strategy.